It's time for a housing market crash update. So let's take a look, see what's going on. Is the housing market going to crash? What are we going to see? Interest rates are kind of all over the map here lately. They went down a little bit. Mortgage rates went down because of bond yields, right? So the bond yields went down a couple of weeks ago, which dropped mortgage interest rates about 1%. So there was a little spur of activity. We'll take a look at that in a minute. Buyers are very sensitive to interest rates. If interest rates drop, that will spur activity for people to kind of jump back in, but they still haven't come down enough. And right now the rates have gone back up because of the jobs report. So we had an increase in jobs, and that's telling the Fed that the economy is still strong enough for them to continue hiking at a rapid and aggressive pace. So the yields were up on that news that the economy is still fairly strong. Recessionary fears are loosening with a strong jobs market. Inflation is the biggest risk to the economy and to housing and everything else out there right now. So that's the Fed's number one job. So Treasury, the 10-year Treasury rose 2.79% on Friday morning on the back of a stronger than expected jobs report for July. There was an increase in non-farm payrolls of 528,000 last month, which doubled the expectations of the market. The markets were down. Everything was down on the news because that says the Fed can hike. And mortgage rates are loosely based on Treasury rates, the 10-year yield on Treasuries, because investors and 30-year investors are weighing the difference between risk-free assets, mortgages, Treasuries, things like that. So the higher the Treasury rates go, the higher mortgage rates will go along with it. And mortgage rates are still historically low in general compared to what I'm used to and what a lot of people my age are used to, but they were way low. They're twice as much as they were at the pandemic lows in those 2% ranges. So here's another effect of housing. Higher housing costs are forcing more pet owners to surrender their dogs. So it's not just housing costs, it's inflation. Everything, rent, groceries, dog food, it's all going really high. So according to a new survey conducted by pet care site Rover, the majority of pet parents say that they are spending more on their animals than they were 6 months ago. So they're having to trade down on food, treats, accessories for their pets. In some cases, owners have been forced to give up their pets altogether. And in other issues are rent spiking 40%, in some places 30-40%. So the only option would be to move, because a lot of these places won't take dogs, or they have a premium on rent for dogs in terms of deposits and a rent premium that you pay extra for having a pet. So the shelters are seeing an increase in people dropping their dogs off. So these are serious issues that people are facing in the housing market right now. Weekly housing trends ending in July. The median home price, listing prices were up 14.7%. The new listings were down 1%. Active listings were down 3%. The time on the market year to date, 7 days faster. But last month, the week ending in July 16th, the 23rd, and then July 30th, you can see how these things changed. From year to date, median list prices were up 15.6%. New listings were down 8% at the end of week ending July 30th. Active listings were up 30%. That's a good sign. Last couple of, pretty much the rest of this month, all this month, listings were up about 30%. Days on market, 1 day slower. These are all averages. But this is good news that not the pricing, but new listings, active listings, things like that. Housing inventory is increasing across the country. So that is good news for the housing market. And housing mortgage update, the uptick in searches and tours with low interest rates. So as the interest rates went down, people started searching more. They started going back to open houses more, things like that, because again, low interest rates are going to spur activity and spur demand. For the week ending July 28th, the 30-year mortgage fell to 5.3%. It was at 5.81%. So that's not significant, but it's enough for people to say, hey, maybe rates are going to come down. We should start looking again. But now rates are going to head back up again and probably get back over that 6% range in terms of mortgage rates. So that's going to keep pressure on the housing market. And every market's different. When you look at these averages, these are just median house prices and averages across the country. The median home sale price was up to 384,871. And that's, a lot of the lower end is dropping out as the prices go up in a lot of areas. So it's going to take a lot of time for that to flip and go back the other way. But the good news is pressure is easing a little bit. And you can see right here, the typical home value was about 354, 165. That was up about 20% from last year. This is as of June. Typical rent was at $2,000. That's up probably 20 or 30% from over a year ago. Rents have been the real big thing that has escalated. Property values too, but rents have really been going up in a lot of markets, doubling and tripling in some markets. The change in typical rent from last year, 14.8%. And again, these are just averages nationally. Every market's different. Some markets, rents are going down. People are moving. There's pressure on landlords. Housing affordability hits a 15-year low as prices and mortgage rates rise. So these are the things that will affect the housing market overall. It's all based on payments. The higher the rates go, the higher the payments go, the less people can afford. There's limited inventory, limited options out there right now, and prices have been through the roof. So if you look at Zillow and do some searches in your local market, you want to pay attention to three things. You want to pay attention to how many houses are on the market and how long have they been on market. Obviously, you'll look at the asking price, but anybody can ask anything. You want to see what price reductions are looking like in your market. So how long have they, how many are on the market? How long have they been on the market? And look at the price reductions. How many are under contract and how long were they on the market? And look at the price reductions on those pending sales. And then look at what's selling and what they sold for. How long were they on the market before they sold? What did they sell for? List price to sale price. What was that discount or what was the increase? Some markets are still seeing, some pockets, especially in some markets, are still seeing competition and people bidding over ask price. So you really want to track that. What are properties selling for? List price, asking price to the settlement price, sale price, and see if there's a discount or premium. And that kind of tells you how hot the market is still. But those are basically three things you want to do. You can look at that on Zillow, track it yourself. You can talk to a local realtor in your market to keep you updated with those things on a regular basis because every market's different. Every area and every market is different. Real estate's hyper local all the way down to the neighborhood, street, and block and position on that street, neighborhood, block, street, position on the street. Everything's different. Views make a big difference, lot size, waterfront, all these different things. So if you're investing or just looking for a year-round home, those are the things you want to look at. Keep an eye on treasuries. As treasuries go up, mortgage rates will go up accordingly, which will bring affordability down. So that should increase inventory levels. The more houses that are on the market, the longer they're on the market, then the more options and the better the prices will get. But it's going to take time. Housing prices are sticky. We are in a very different scenario this time than 2009. So, sellers are not necessarily in a position where they are motivated to sell, where they have to sell. A lot of people are putting their houses on the market, just trying to cash in and thinking that we're still in a position like we were a year ago when rates were at record lows and that there's going to be 20, 30, 40 offers. So sellers are getting a rude awakening right now with lack of competition in a lot of markets with prices coming down, and a lot of people don't have to sell, so they'll just put them on at whatever price, and if it doesn't sell, then they're fine. And then there will be people that do have to sell, and if you're in a situation where you do have to sell, you really need to be sensitive and in tune with the market and make sure you understand what the sales prices, what the comps are in the market, recent comps. You can't go back 6 months like normal. You have to go back 30 days, a week, to kind of really track what things are selling for right now versus what they were. And of course, the traffic is huge, right? So there's two things that make a house sell, make a property sell. It's price and traffic. Those are two things, and they're directly connected. The price action is going to determine how much traffic. So those are the two things you need for a property to sell if you're in a position to sell. If you're looking to buy for either an investment or to live in, I think patience is on your side. It's going to take a while for the market to correct. You need more inventory. Of course, there's still strong demand, but as the affordability continues to diminish, the demand will diminish. People have checked out of the housing market, sitting on the sidelines. But new construction communities are where you're going to get the best deals the quickest. So if you're in the market for a new house, you want to go to a big development where builders are building new homes. And if they have a lot of homes sitting and not selling, and they have a lot of houses that were under contract that fell out. Those are going to be opportunities for you to get a really good deal with new construction, new homes, depending on your market where you're at. So these are the things I'm looking at in the housing market. I do not anticipate a major crash in the housing market like a lot of people are calling for to get clicks and views. I think the housing market is correcting, and it's correcting at a slower pace than what we saw in previous times. But if interest rates shoot up exponentially, 6-7%, you'll see the market correct faster. The higher the rates go, the quicker the decline will be in the housing market and in values in most markets. But right now, rates are still relatively low, historically low, but with inflationary pressures, energy costs that are doubling in a lot of areas of the country and around the world, that's going to have an effect on people's affordability index as we get into the fall and winter and going into next year. So we'll just have to wait and see how these things shake out, but I do not anticipate a crash in the housing market like we've seen in the past. There's just too much demand still, not enough inventory. Until we get back over 2 million homes on the market, you're going to see continued pressure on prices and demand. So these are the things I'm looking at. I'll see you in the next video.